Welcome to Alfonso Cajero, Financial Modeling Tutorials. Chapter 8. How to build a financial model in Excel. Building a financial model in Excel involves creating a structured tool to analyze a company's financial performance, forecast future results, and make informed decisions. Start by clearly defining the purpose of your model, whether it's for forecasting revenues, evaluating an investment, or assessing financial health. This will guide the structure and content of your model. Gather all relevant historical financial data, such as income statements, balance sheets, and cash flow statements, which will serve as the foundation for your forecasts and ensure that your model is based on historical performance. Next, set up your Excel workbook with a logical structure. Create separate tabs for different components: assumptions, historical data, forecasts, and financial statements. In the Assumptions tab, input key variables like growth rates, cost drivers, and capital expenditure plans. Document and label each assumption clearly for easy reference. In the Historical Data tab, input accurate financial data, organized chronologically, to help derive trends and validate your forecasts. In the Forecasts tab, build your projections based on the assumptions and historical data. Start with revenue forecasts using historical growth rates and market trends. Then forecast expenses, including cost of goods sold, operating expenses, and capital expenditures. Ensure these forecasts are realistic and grounded in historical performance and market conditions. Use the Forecast tab to populate the financial statements, income statement, balance sheet, and cash flow statement. Ensure these statements are interconnected. For example, net income from the income statement should flow into retained earnings on the balance sheet and serve as the starting point for the cash flow statement. Once your model is built, review and validate it thoroughly. Check for consistency and accuracy by comparing outputs with historical data and ensuring that key assumptions are realistic. Advanced techniques like scenario analysis and sensitivity analysis can be added for more sophisticated insights. By following these steps, you will create a comprehensive financial model that provides valuable insights into a company's financial health and helps inform strategic decisions. Thank you for watching, and if you found this guide helpful, be sure to like, comment, and subscribe for more financial modeling content.